Good day, and welcome to this special interview with the team from Denker Capital, who manage the Nedgroup Investments Financials Fund. First up, we have Koki Koiman. Koki, welcome.
Yeah, no, thank you very much, Anil.
Great. We have some really interesting questions for you and the team here, so let's just jump straight into it. Is that okay?
Yeah.
Excellent. So, Koki, first up, what's the universe of companies that you tend to look at?
Yeah. So our universe is financials. That's our circle of competence. And within that, that obviously includes banks, and within banks, it's a wide investment banks, commercial banks, retail banks, credit card operators, insurers, P&C life, exchanges, debt collectors. So the whole gambit of financial sector companies, and then basically worldwide. So anything from Argentina, although we're not looking at Argentina, to Russia, another extreme at this stage. So yeah, global financial services.
Okay, thanks, Koki. And just in terms of inflation and interest rates, which are rising at the moment, would you say that's good for the sector or not, and why?
Yeah. So Anil, inflation is key at the moment, and interest rates. So generally, higher interest rates are good for banks and insurers. Rising interest rates are even better, especially at the beginning of a cycle where we are now. And that's mainly because the banks, when interest rates are low, the banks' margins are squeezed. So what we call the net interest margins. In other words, the difference between what they pay on deposits and what they lend out. But as interest rates start rising, the deposits is a huge amount of lazy deposits on their balance sheets, which they don't have to pay a higher rate for, but at the same time they can start charging higher interest rates on the money they lend out. So the net interest margin picks up. But secondly, at the same time, higher interest rates normally means a global recovery, or a country's recovering in terms of economic growth. So that means more demand for loans. And at the same time, at the initial phase, lower bad debts. The world is slightly different now, especially with the war having started in Europe. So you could have more inflation, which, funny enough, is even better short-term, because inflation actually does bring about more loan demand. But you could see the interest rates lagging a bit. But the environment we're seeing going forward for the next 2 to 3 years would be inflationary and higher interest rates, better loan growth, which is all very good for banks, who are at this stage still at very low valuation. So you could see a multi-year re-rating of the sector as well.
Okay, brilliant, Koki. That's very insightful. Thank you very much.
Pleasure.
Next, I'd like to invite Barry de Kock, who is the expert on insurers in the team, to join me. Barry, welcome.
Thanks, Anil. Hi.
Barry, so maybe a bit of an ESG question for you. I'd just like to know, so what's been the impact of climate change on the insurers, please?
Sure. So, Anil, it's quite easy to see, just looking back a couple of years, that climate change has had a meaningful impact on the industry. If you look back over the last 5 years, we've had a massive amount of large natural catastrophes in the form of hurricanes, but also in the form of secondary perils, such as big floods, a lot of wildfire activity, particularly in California and around the globe. And that is clearly as a consequence of climate change. So you're seeing very interesting phenomena where you're seeing fire seasons overlap with wind seasons. When an event happens, it's obviously massively exacerbated because of things like this. You've seen sea levels rise, which means that the impact of storm surges are now much more potent. And obviously, at a sector level, this is impacting them significantly. And we can see that in the financial results. If you look at the insurance sector over the last 5 years, a lot of companies have struggled to meet their cost of capital and simply just haven't made enough money. So what is their response? What we've seen over the last 2 years or so is that companies have begun to reprice for these risks. So we've seen prices across the board pretty much, but specifically for cat-exposed lines increase materially over the last 2 years, as the companies are now trying to make a decent margin on the business. There are also opportunities for profitable growth, because the sector has a role to play in overcoming climate change and in working with customers, government and other stakeholders to help close a protection gap. And one one thing that was clearly evident is that there is still a massive protection gap globally. Europe was a great example. We saw the flooding a couple of years ago, where the economic losses were a lot larger than the insured losses. So the insurers have a critical role to play in working with clients, businesses, and communities to understand the risks, prevent the risks, and obviously step in when losses need to be paid. So we think that the sector looks very attractive at the moment. This is one of the reasons it is sold off. And we think that we are invested in companies that are going to make the most of the available opportunity set via great underwriting and good forward-looking modeling, and ultimately sort of protect communities and do very well for shareholders.
Thanks, Barry. That's actually very interesting indeed. Thank you.
Pleasure. Thanks.
Craig Metherell is the expert on fintech in the team, so I'm going to ask him to join me now. Craig, welcome.
Thanks, Anil. Thanks for having us.
Brilliant. So Craig, fintech's really been disrupting the space. What are you seeing in terms of the developments here and potential opportunities? What are you finding?
Thanks, Anil. I think first and foremost, the term fintech has been around for many years, but what we've seen over the last 2 years or so with the onset of COVID is the rapid adoption of digital ways of transacting in the financial services sector. That will be from making payments, shopping via e-commerce websites, and so on. And that's created a lot of excitement around the space. Now, we like to think of it in 3 broad categories. You have your incumbents, you have your enablers, and you have your disruptors. And we found over the years that, from following the space, that many of the disruptors initially can become incumbents over time. And a lot of the incumbents that we are either invested in or following have invested a great deal in terms of technological spend and investment into technological capabilities. So the fund has exposure to what we would consider fintech opportunities. One such example is Tinkoff, a Russian fintech business, which is a contentious point at the moment given what's going on in the world. And I'm sure you might ask us that question later about our Russian exposure. But it's been a phenomenal business that adopted a fintech approach to its business. It disrupted the traditional Russian banks and has evolved and adapted into what we would consider a leading global fintech player, and is highly profitable and has developed immense resilience through various crises as well. So we have exposure there, and we're watching that very closely. Another investment we have made is into a business called VEF. It's a Stockholm-listed emerging market fintech investor. What we find very attractive about this opportunity is that our interests align very closely to the management team of the business. They're very shareholder oriented. They're focused on generating sustainable and attractive returns, and are really trying to capitalize on the secular growth trend in the fintech industry. But by investing in or by managing a portfolio of unlisted fintech investments, this gives us exposure to that space, which we traditionally wouldn't have. And having said that, I've mentioned the incumbents, the likes of JP Morgan, for example, a leading player in the space, the largest bank globally, has invested a great deal in ensuring that its technological capabilities are world-class and are staying ahead of the competitive threat that these fintech players are bringing to the table.
Thanks, Craig. You actually mentioned the word contentious. I just thought maybe another contentious one for you is just on decentralized finance. Is it a threat? Is it an opportunity? What do you think?
We're getting this question more and more lately. And I think to sit on the fence with the answer, it's both a threat and an opportunity. The adoption of, or the term DeFi has certainly escalated in the last, or the use of the term has escalated in the last 12 to 18 months, as I think the euphoria of people making a lot of money in things like Bitcoin and Ethereum and so on has attracted a lot of interest to the space. But it goes back many, many years before. And I think at its core, DeFi, by its definition, decentralized finance, is there to disrupt the traditional finance space. But it has evolved so quickly because it is an unregulated space. It's low cost in terms of startup costs. Anybody can sit behind a computer and code something. And it has attracted a lot of interest because of this. And it also appeals to use the term, people more of a libertarian nature, given that it cuts out the traditional financial intermediaries who are sort of tied up in complexity, opaqueness, and we've been watching the space very closely. Now, whilst I say it's a threat, the reason why I say it's an opportunity is that we've been following our companies, asking a lot of questions about the space, and have found that in many cases, the banks, the insurers, they've started to introduce this technology themselves. So whilst they might have shunned it initially, they have certainly seen that there is value in the underlying technology. So this sort of takes a step away from, the popular things that are attracting people like Bitcoin and Ethereum to the actual value of the underlying blockchain technology and how that can fundamentally change and improve the system. So we've seen the likes of some of the US banks, JP Morgan, for example, introduced the JP Morgan coin, their blockchain technology called Onyx, and another one in the US, Signature Bank, which is one of the largest crypto exchange depository. It certainly benefited from the rapid growth there. And what we're finding is that the financial institutions around the world have identified this massive threat and are certainly rising to the occasion in terms of trying to either counter the threat, morph the two worlds between DeFi and, to use the term TradFi. So even in the payment space, for example, companies like Visa and MasterCard have identified that clients or customers might want to store value in the DeFi world, but still need to transact in the TradFi world. And they are either partnering or acquiring businesses that are able to facilitate this kind of behavior. And I think, we follow financial companies around the world, and you get those that are, call it DeFi zealots or maximalists. I think we probably sit in between the two spectrums, in the middle, where we think that the two will coexist. But we do think that in the DeFi space that has grown so rapidly because of this lack of regulation, that you're probably going to find more and more regulation comes going forward.
She's very interesting, Craig. Thanks very much. I guess the last question for you before I let you go. If I said to you, I expect to make money by buying high and selling low, I know you're going to laugh at me. So very importantly, what can you tell us about valuations?
So I think from the fund's point of view, firstly, we're very focused on companies that can deliver sustainable shareholder value growth. So if we were to just break it down in terms of fund characteristics compared to, say, the benchmark, the fund is trading on roughly on an aggregate level about maybe 1.1 times 12-month forward book value, versus the index it's probably around 1.3 at this point in time. And we think that the companies that we're invested in can deliver shareholder value growth of between 12 and 15% in US dollars over the next, sustainably, but certainly over the next 12 months. Now, part of that you're going to get in the dividend yield, say around 5% in dividend yield. And just given the way valuations have derated recently, you're probably going to get some more in re-rating as well.
Brilliant, Craig. Thanks very much. So to end off, I just want to ask Koki maybe a few big picture questions now. So Koki, the first one is just about if you have any Russian holdings and what are you doing about those at the moment?
Yeah, that's a tough question. One always, and what we do in any case every year, look back at mistakes made. And, when you now look back, you shouldn't have held any Russian or any Central Eastern European exposures. But that's not the world we live in. Central Eastern Europe was one of the growth areas in the world. Russia was doing unbelievably well. Funny enough, obviously, that strong balance sheet that we liked of Russia has enabled Putin to start the war, because he's actually made his country, I was going to say bulletproof, insensitive to sanctions. And we saw that as a strength, but it's been a weakness, obviously, in that it allowed him to go to war. But we didn't foresee that. So we had exposure in Russia, two companies, Sberbank, which as events started unfolding, we sold simply because of its state ownership. It's a great bank, and you cry when you have to sell, because management got nothing to do with this. But we sold Sberbank. We've still got Tinkoff, one of the best fintech companies in the world, done unbelievably well for us. We bought it post the 2014 invasion in Crimea at $3. It went all the way to, I think, a high of $120 in the next few years, and it's actually today back at $4. So we sold that when it got too expensive, not enough with hindsight, but we reduced the position. At the moment, it is, I think, 0.5% in the fund. The big question one sits with now is, how long does it go? How bad does it get? Is it morally right to now buy more Russian shares? What does one do? So the fund does have exposure to other banks in the region. Erste Bank, which is in Austria, no exposure to Russia or Ukraine, but it's also been sold down heavily simply because it's in the area. Even something like Swedbank in Sweden, been sold down a lot because it's got 10% in the Baltics. And the fear now is that does Russia invade the Baltic countries? So there are a lot of opportunities in that area now, and we know the countries and the banks extremely well, having been visiting them since 2000, even before that. So we know the management, so we're actively looking the whole time. But at the moment, the position Russia is 0.5%, in the region about mostly now 4%. But we would actively be looking now at where the market has become too fearsome to add to that.
And Koki, maybe related to that, so where else in the world would you be avoiding holding stocks at the moment?
Yeah, so countries we have avoided, obviously been Argentina, Pakistan, I mean, obvious. Turkey is one which I actually loved. We used to always have fairly good weighting in Turkish banks because of their good technology. But since President Erdogan seemingly started losing his mind, we sold all our Turkish positions. We haven't got anything there. We find it's just unpredictable. China is now, we haven't held Chinese banks for a long time, 5, 6, 7 years, when we foresaw the property problems that are now playing themselves out. And look, we were too early. We saw that 5 years too early, although the banks have never actually performed there. So we were right in that sense. And so China is still risky. I mean, one of the really way out risks now is that China uses this opportunity to invade Taiwan. So you don't want to be owning any Chinese stocks then. Very, very low probability, less than 1%, but it is. So China's one, we've got a bit of exposure recently through HSBC, which fell a lot. Very good bank, spent 10 years recapitalizing itself. So that's more how we've been investing in that area.
Thanks, Koki. And maybe just the last question for you then is just a bit more on the characteristics of the fund and outlook for returns, please.
Yeah. So maybe the most important characteristic is we really know and understand the companies and the banks, insurers we invest in very well. We've got a team of 5. All of them are specialists and are highly regarded even by, I get feedback from the managements. We talk and say, yeah, your guys really understand our company. We've been visiting them for many, many years. So I think the one characteristic is when we invest in a financial services player, we really understand the company. Secondly, it's got high quality. So we very seldom buy in turnarounds unless we really understand that the turnaround is working. And thirdly, it's diversified. It's diversified amongst banks and insurers and debt collectors, exchanges, but it's also diversified geographically. So at this stage, it helps. The fund is 50% invested in the US. So even Russia at that stage, when events started happening, was 2%. So it's diversified geographically and amongst the industry.
Okay, thanks, Koki. And obviously many thanks to you and the team for the excellent work you do on the Financials Fund. May the strong returns continue.
Yeah, no, thank you very much, Anil.
Thanks to all of you for watching. Take care and stay safe.